G'day all, Joel here.
G'day, this is Chris.
This is Money in the Tank. This episode we're discussing all things shares 101.
And we delve a little bit into the brokerage firms you might want to use and the things associated with share trading that you might want to know in the domestic, and we touch a little bit on the international markets.
Hopefully just to give you guys a nice, easy to understand overview of what shares are all about and how they work and operate, and also hang around at the end for a great what do you choose, or what's the other name I used, Arnie?
Either or, what do you choose?
And yeah, have a listen to that at the end to tell us your thoughts and hopefully think of a new name for us because I keep mixing the name up. So welcome back everybody for the third podcast of Money in the Tank. My name's Joel. And we've got Arnie, aka Chris, on the other line to go through some shares 101 with you guys today. So firstly, Arndog, how was your weekend, mate? How's things shaping up for you?
It's been pretty good, mate. I was a bit crook during the middle of the week, so the weekend, I was hoping I'd be better by the weekend, and it came good. So yesterday we caught up with a few mates, and as you know, my wife and I got a newborn, so we introduced some of our mates to the newborn, which was good, Olivia. And just been kicking it. What have you been up to, mate?
Good, man. Yeah, just enjoying the last bit of nice Melbourne weather. Hopefully we get a bit more, but hitting up the pool and just played with the kids yesterday and did a bunch of stuff with them. Man, just play centres and all that stuff that you do as a parent with the young kids to try and keep them entertained, and went out for a nice bit of dinner last night in Fitzroy. So very good weekend. Very good weekend.
Mate, you got to take your opportunities when they come because you never know when we'll be thrust back into lockdown.
Exactly, mate. Exactly. I was so busy this weekend, dude. I got a haircut yesterday and it was just absolutely manic at the shops. Like I think everyone, because they were locked down for so long, it's just everyone sort of come out of their bunker and just, made the most of the freedom.
So we got a bit of good feedback during the week from one of our mates, Leo Mira, and maybe you tell us what he wanted us to talk about. So that's what we're going to
First, I have to correct you on Luke's definition of mate, Leroy. He'll get a kick out of that. Still waiting on my our drinks celebration, Lee, as well, and dinner out, mate. It's your shout, so we'll eventually get that by 2050. Leroy actually hit me up. He jumped on the podcast this week, which was great, and we appreciate it. And just mentioned that he really enjoyed, the toing and froing and the chat with just you and me, and trying to make it easy to understand. But he also wanted to see if we could sort of shuffle back a touch and bring it back to some basic shares 101. So we thought today would be a great idea early on in the podcast throws to get into some talking of stocks and just breaking it down a little bit more at a high level and fleshing out what it is to invest and what shares are and how they operate, and more so from a domestic standpoint from Australia for starters, I think.
As in just investing in domestic shares, or do you want to touch on how you invest in international shares as well?
We could do that today, or we could do that for another podcast. We'll see where the wind takes us, Arnie.
I like that. Yeah, actually, another mate of ours touched base on this same topic, Breno McBride. Just a bit of a shout out. So this will benefit a few people, I reckon. Let's jump into it then. So maybe do you want to walk us through what a share actually is, Jolie, and then we can go from there?
Yeah, absolutely. So a share, for example, has a couple of different names. You could have heard it as a stock or as an equity. So it's essentially buying an equity in a company. So a company puts out shares, usually in the millions of shares, once they want to publicly list on the market, and then you as a public person, for example, in Australia, wants to buy some of that company, you can purchase some of those shares off the market, I guess you could, so to speak. You could buy them from a platform, which we'll go into a little bit later, what are platforms and how they work. So it's a public venue to buy and sell a certain share or a certain company. So it works on supply demand. So in Australia, you may have heard on the news or heard before, they've got the All Ordinaries, which is known as the All Ords. So that's the largest 500 stocks listed in Australia in the ASX, which is known as the Australian Stock Exchange, so another acronym, according to their market capitalisations, their size. So it's the number of shares times the share price. Another acronym you may have seen as well around is the ASX 200. Now that's just the top 200 stocks listed in the Australian Stock Exchange. So that's essentially what a share is. And Arnie, did you want to give, I guess, an example of how a share operates once you buy it, what it does, and how you go about buying it?
Yeah, I might just add a few little things before I do. Everything you said spot on. The reason why a company wants to issue shares publicly is because they might be trying to raise money to grow their business. And then once an investor buys those shares, the reason they want to buy those shares is to get money. And typically the way you get money from a share is through companies that pay a dividend with excess cash flow, or if the price of that share might appreciate. So I think just after I've said that, sorry, I've forgotten your question. What was it, Jolie?
Yeah, I was just going to say, you sort of touched on it at the end there. So maybe just expanding on buying a share and what capital growth is, what dividends are, and how they work would be a great place to start. We spoke about a newly listed company, but it could be an example of a company that's been on the stock exchange for over a decade, and their people are buying and selling shares of that company. So they're not newly listed; they've been around for a long time, and you can buy and sell these shares on a publicly listed forum or venue.
Yeah, sure. So what you said is exactly right. They'll have shares outstanding if it's an existing company that's been on the market for a while, and the share price reflects one unit of that total market capitalization of the company. So if you added up the price of all the shares, that would give you the total value of the company. So there's different catalysts that might come along and affect a company's share price. Interest rates could be one, or they might have a big product coming to market, which could be a positive catalyst, which is going to make the share price appreciate, and the capital, the valuation of those shares will move up over time. And then if you're an investor and you've been holding those shares for a long time, you can sell and realize the profit, the difference between your cost basis and whatever the share is when you sell it. Obviously, when you sell, it has an implication on the taxation of those profits. I think in Australia, if you hold a share for less than a year, then you get taxed on the full amount. However, if you hold a share for longer than a year, then you're entitled to the capital gains tax discount, which is 50%. Dividends, some companies that are well established who don't really have anywhere else to put their money, or they may not think they've got a better option, want to distribute that money to their shareholders, and they do so in the form of a dividend. Typically, dividends can be paid quarterly, or some are semi-annual. And that's just the excess money left over after everything's all said and done, and they don't need to retain any of those earnings because they have nothing to invest in. So it doesn't really matter to the individual investor whether or not you try and get your money through capital appreciation or through dividends. If you'd be happy either way is what I'm trying to say, because if a company is taking that money that they would have used for dividends, but they're investing it in their own growth, then that's going to drive the shares up through capital appreciation.
Yeah, great rundown, and I think a great example of an international stock, which we mentioned the other week, was Warren Buffett's stock, Berkshire Hathaway, which has had huge amounts of capital growth over the years, and I don't believe, correct me if I'm wrong, they've ever really paid a dividend. It generally has always been reinvested back into the stock, because he's always the person at the forefront of the research and investing, and he says, well, people own the stock because I can do a better job than them usually at investing it, so why pay it out as a dividend? Why not reinvest it and continue to have that compounded growth, which is another word for buying more of the stock with the dividend itself.
Yeah, that's exactly right. They've actually said that in their... Warren Buffett and Charlie Munger famously always release a letter to shareholders. And I think a while ago they said they'd be happy to pay out a dividend if they couldn't find any opportunities to grow the capital in the company. But they always do. And I think recently Warren Buffett's come under fire from a few sectors because Berkshire released their 13F, and it shows that they took a really large stake in Chevron, the oil company, for those who aren't aware. Chevron has a very large dividend, so I'm sure the investors won't mind too much as long as the company stays, earning money and paying out those fat dividends. But in general, people were criticizing Warren, as they have done many times in the past, and sort of said, what's he doing? Has he lost his touch? Why is he buying an oil company at this point in time?
And just, I guess, to elaborate just some more on some general information with stocks, and just to also touch on the dividends and whatnot that we spoke of, is with shares, for example, you can actually have the dividend reinvested, or you can take it as cash. So some people will buy a share purely just to get the dividend. Might be Telstra, for example. They love the dividend that comes from it. It's just like having their money in the bank, for example, with a bit more risk associated with it, and they know that they're going to get some kind of dividend coming each year, and the companies tend to like to try to keep that consistent. I guess a good example of how it works is if you were to buy a share for, say, $100, or let's say $90, and you held onto it for 12 months and it ended up being worth $100 at the end of the 12-month period. During that period of time, you might have received an interim dividend and a full dividend. And let's say that dividend of the $100 share was $5. So you're effectively getting a 5% dividend. In terms of another thing that you may have heard is franking credits. So what that means is if you've got a dividend from a company and it's paid you $5 for owning that $100 share, that might be a fully franked dividend, which means that the company's already paid tax on that dividend at 30%. So that means that if your tax rate is higher than that, you'll be able to claim a bit of that franking credit discount back off your tax return. But if it's lower than that, there might be some tax for you to be able to claim. So it's important to always seek tax advice and look up the ASX website for general examples on that. But I just wanted to explain how dividends work, and capital growth is potentially that stock that you've owned from $90 and it's gone to $100 throughout the year. That $10 is what's called capital growth over that period of time. So you've got your capital growth, and you've received a $5 dividend along the way, which is classified as income, and that dividend goes on your tax return. And depending on your tax situation, it could be increased if you are able to claim the franking credits back. Like a retiree that might not be paying any tax, they could potentially claim that 30% franking credit back on their tax return.
Yeah, that's a really good explanation of all those aspects, Joel. So there's a few things I want to touch on in regards to Shares 101, and some of those things are what account you might want to choose and open, the fees associated with that, and then I guess the risk associated with what you might be doing based on how you invest actively or passively. But I think what it all boils down to before you make those decisions is what kind of investor are you? Do you want to take on risk? So do you want to be an active investor and pick the stocks yourself? Do you want to passively invest through a managed fund or index funds or even a robo-advisor? And I think that also is based on your time horizon, which we have touched on in the last couple of weeks. Like, how long have you got left to invest? Are you in your 20s? Are you in your 30s? Are you in your 40s? Are you in your 50s? And, what do you want to do with your money? So I think that's the first thing you need to work out. And once you've worked that out, then you can decide, okay, I want to take a bit more risks here, and I want to, concentrate my portfolio a bit much and try and get a lot of growth here. Or, I don't want my money to dwindle. I want it to be safe as houses, and I'll put it in some very safe assets.
Yeah, absolutely, Arnie. And I think that always comes down to choice and investments and choice of what you want to own and what you want to do, whether you have the time and ability to invest and study and research. So you can research companies' annual reports or companies' assets, or a varying company. So you're choosing between two different companies, for example, a financial company like the CBA and Westpac, and you're reviewing against what their time horizon looks like and how the future is shaping up for them. So it's all a lot of choices. So you can go and do some research and read books like we've mentioned before in the podcast, or you can, as Arnie said, outsource it to robo-advice or an advisor or a broker. You can use an exchange-traded fund, which is called an ETF, as an acronym, where you can buy a basket of stocks. So you don't, or a managed fund, so you don't necessarily have to want to or do all the research yourself. You can actually outsource all different areas depending on what your preference is, and also within that it comes with risk profiles as well. So risk is anytime you're investing probably above cash is always going to entail some risk. So when you got the money in the bank and in a term deposit, for example, it's fairly minimal risk. Because you've got your money in there, let's say it's $100 or $100,000, and you get your interest at the end of the year, which is pretty low nowadays. You're going to get that money back, and you're going to be pretty confident it's going to be there for you. But over time, effectively, if you've got time on your side, the risk curve goes up as you go. So you've got your cash or your term deposits, then you've got your bonds, then you've got some property or infrastructure, some shares, some international shares. So the risk profile, the risk curve goes up. So the more risk you're taking on, the more your money can fluctuate and go up and down, but the better outcome you'd be hoping to achieve over the longer term. And that's where time horizon comes into play, Arnie, as you so well mentioned before.
Yeah, and if you want to learn as well, there's a really good online resources. So there's things like the ASX website, or a lot of the brokers themselves, like CommSec, for example, have courses. You can do short courses to learn these sorts of things. And I think a lot of them also have paper trading accounts. So once you know these sorts of things and you think, I don't know if I'm a passive investor, or I don't know if I want to try a bit of active investing, you could open a paper trading account, have a go at it. It won't cost you any money. And then before you start diving in with your actual dollars. So maybe we could run through a few of the brokerage options available, Jolie, and then come back to sort of what kind of fees they might charge.
Yeah, so I think what you mentioned is the ASX has a dummy platform where you can have dummy dollars in there and have a crack at it and see how you go over time. So that's a great way to learn, a good place to start. Some of the different platforms out there that I've just got over the years or Googled as well is you've got CommSec, which is probably your biggest player in Australia. I think are they $9.95 for a trade, Arnie, or are they $19.95? I forget.
It can be $9.95 depending on how much you're trading.
Gotcha. That's right. Yeah. So all these companies that we mentioned, it's all general in nature, but they all have different brokerage costs. So don't hold us to it. But you've got CMC Markets, IG Markets, Westpac, NAB Trade, Stake, eToro. So you've got a range of different platforms out there or brokerage platforms that you can buy and sell stocks from. Some will be quote unquote $0 trades, but you've always got to be mindful of that and read the fine print. And then some will be a fixed cost, as we mentioned before, for a CommSec trade.
I might say a good place to do a bit of comparison on these brokerage sites is a website called Canstar, CANSTAR, and you can look at domestic share trading and you can look at international share trading, and they typically have a ranking by star rating of these things based on the products available, the fees they charge, the currencies they trade in, whether they've got online trading or not, whether they've got analyst recommendations or brokerage advice. So as Jolly was mentioning, that the ones that it costs a bit to trade on typically have more of what you would call full service. So they might have analyst recommendations, or they might have services that talk about financial planning, for example. So maybe we'll talk about the ones that we've used. What ones do you use, Jolie?
Yeah, so I tend to use just your normal CommSec account. I've had that since I was a youngster, so I've just stuck with that over the period. And what about yourself, Arn?
I've got 3 at the moment. I also started with CommSec. I've got CommSec and CommSec International, and I've been very happy with them from a customer service point of view, and I feel like the security there is unparalleled in the Australian market. I've also dabbled with Stake because I was interested in it when it first came out, but I've kind of gone away from it now because I don't like that I can't have the full service of a traditional broker. And the other one I've used is Interactive Brokers, which is probably the cheapest one you can get in our market, I think. When I say cheapest, like obviously you still have to pay more than with a Stake or an eToro, but I've never used eToro, never used a Webull, so I'm not sure about those ones. But Interactive Brokers is pretty good.
Yeah, it's a great rundown, and I think one of the other things that I just jotted down on some notes there as well was just some of the new different investment apps that have come out over the years. So I think things like Acorns. So you've got those apps, and you might know a couple more names, Arnie, but where effectively you can take a few dollars and it plugs it straight into an investment for you. So there's some new and I guess modern apps that can be done without having to actively do it. The only thing I guess to be mindful of that is just the cost sometimes involved, or the management costs of those funds can sometimes be a little bit higher. But as I've always said, you're better off looking at options to invest, or looking at investing rather than doing nothing at all. I think it's a better option to be looking at, as long as it's got some quality behind it, or there's some decent research behind it as well.
My personal feeling about those kind of apps is, it's a good way to see how it works, but you're right, they really kill the users on fees. So I wouldn't advocate anyone staying on those kind of platforms for too long. But what you did spark then in my mind, well, one is let's talk about fee structures, but two, we said this before, robo-advisors, and I wanted to briefly touch on what a robo-advisor is. I think one of the biggest ones in Australia is Six Park, and basically what they do is they take the consumer and they do a risk profile of them and sort of see how risk averse you are, what your time horizon is, like how long you've got left to invest. And then they allocate a portfolio for you based on what you've answered, which might include stocks, property, bonds, some cash, other instruments that you might want to invest in. And then it will basically do all the rebalancing for you. I think it may do the tax planning for you as well, based on how much you want to contribute and how regularly. So that's another option that people can look into.
Yeah, absolutely. Yeah, there's so many different options out there. And when you talk about advisors, robo-advisors, intra-fund advice, like there's stock brokers. So it's all about what's going to be suitable for the person or the client. And essentially you want something that's going to be working for you. It's going to help you improve and help you be a better investor over the longer term. And I guess an example that we spoke just briefly about before we started the podcast today was just if, the colloquialism of shit hits the fan, you've got a trusted person there or someone there to be able to help you, to be able to navigate through, like what we saw this year with the pandemic, where the market really fell off a cliff. I think it was about 40% down at one stage in March there. So, if you're going to a source where it may be the cheapest out there, but that the issue is if you don't get the right guidance on the way out of that, you could potentially do a lot more harm than good to yourself. So if in effect you're saving some money on going something a little bit cheaper, but you end up costing yourself in the long run by making silly errors over the longer term. And that's something that we talk about, in the advice land and as an advisor. A lot with clients is trying to minimize the mistakes that are made along the way to help maximize the eventual outcome for someone. So because there's a lot of potholes in the road, and if you can navigate those with a bit more clarity, it can really help the returns and the outcomes for an individual over the longer term.
Well, that's the benefit to paying an advisor or a full service broker, right? Like if I want to make an investment, I call up Joel and I say, hey, is this a good investment? And you say yay or nay. Whereas if I'm in a robo-advisor, I either just have to have the conviction to maintain the investment and, the AI or the algorithm will do its thing. And if I can't and I sell at the wrong time, then, I could have made a catastrophic mistake. So, but you may not have. So I think, just coming back to the fee structure, we've sort of talked about like how much some of the brokerages may charge. You need to do your own research on that because it varies widely and greatly depending on domestic shares and international shares. But the best way to think about it is as a percentage of the investment. So if I'll use CommSec as an example because that's what I'm familiar with. If you're making an international transaction on CommSec, up to a certain amount, they're going to charge you $19.95. And, if you say you want to invest $600 worth of shares and they charge you $19.95, then that works out to 3.3% of the investment. So that's a cost that you've got on the way in. And if you sell, they're going to charge that same amount on the way out. So it's another $19.95. So you got to think about that in absolute terms, like how much have you lost just on the fees? And therefore, if you're investing larger amounts, if you're investing, $10,000, well, that's going to be, 0.2 of your investment. So it's not as bad. And that's kind of what attracts people to these no fee structures is they know that they can save on those costs. But then, as we discussed last week, there may be other hidden costs there. It's also a benefit of index funds. The reason people go with someone like a Vanguard in Australia is that they know they've only got an account fee that's per annum, and I think it's 0.2%, or maybe it varies based on which index you're investing in. But generally, they're quite low, and they're capped at a price as well, so you can never go above a certain amount.
Yeah, correct. And an ETF is a basket of stocks, for example. So an ETF Australian fund might encapsulate the ASX 200, so those top 200 companies, and you'll have, if you've got $10,000 to put into that fund, for example, then you'll get a spread across those different stocks within that fund, and Vanguard is effectively the manager, and they make the adjustments ongoing for you and give you out the paperwork for your tax returns, etc. So it's investing into an indexed fund or an ETF is that example. The one quick one I forgot to mention, we've got to mention earlier, is when you log on to a CommSec account. An example, we're not promoting CommSec or any other trading platform, we're just sort of giving examples in general, help people understand and follow. is you'll have what's called a buy and a sell on there, so buy and sell orders. So if you're wanting to buy a stock and buy a stock for, let's say, $50, you've got to have, on the other side of the ledger, you've got to have someone willing to sell it to you at that amount. So you can actually do an at-limit order. So you can say, I want to spend $50 on this stock no matter what, but someone's wanting to sell it at $51, so you don't quite meet that trade. Or you can execute on market. So essentially, at the end of the day, you'll say at market, whatever the market price is for the stock, I want to buy 100 units of that stock at $50. They'll execute that trade for you, and then you've got your T+2 turnaround time, so you trade plus 2 days, and then you'll own the stock after those 2 days, business days have finished up.
Yeah, good call, Joel. And that's the same on the sell side. You've got those options again.
Yeah, exactly. And you'll also see number of units as well. So if you're trading in a stock that's not regularly traded, for example, like a smaller specky stock, which we've spoken about on previous podcasts, you may not have the actual volume there to be able to make the transaction occur, if that makes sense, Arndog.
Yeah, so if you've got a lot in a stock that we might call illiquid and no one's willing to buy those shares, then basically you're left holding the bag until someone comes along and wants to buy them. So that's something you need to be wary of as well, yeah.
Yeah, so that happens as well. So you'll see all those kind of things when you log onto an account, and a great way to do it is, jumping onto an ASX and learning, or just opening up a trading platform that you feel happy or comfortable with, and just having a look around and doing a bit of research and working it out. And that way you learn along the way as well, and learn for yourself too, which is a great way of doing it.
I think we've covered the basics of investing in shares and the different type of investors that might be out there and why you might want to. And I think we're both in agreement that it's better to do some investing as opposed to no investing. Is there anything else we need to cover in terms of a shares 101, Joel? I think we've covered everything.
I think the only other things I've jotted down here is when we're referring to things like ASX 200, for example. That's your top 200 stocks in Australia. I just wrote down a few other things you might have heard of people say blue chips before. So blue chips is generally your stocks from your number 1 stock to 50, and as an example in Australia. So within that area, you'll probably see stocks like CSL, Wesfarmers, CBA. That's just an example of stocks that'll be classed as your top 50 stocks in Australia and your blue chips. And then as you push down or push up, I guess, in numbers, you go to a mid cap, which is a middle-sized company, so makes up the middle capitalization of the market. And then the small caps. So small caps are usually outside of the top 100, and they make up the smaller market capitalization. So just some more information, I guess, for people to understand whenever they're hearing these things said or acronyms said. That's just a brief example of how that translates.
Oh, there's so many acronyms and there's so much lingo. But as you go through this and you sort of, play around a bit, you'll start to learn and see it more often, and it becomes second nature. It's something that I have to pull myself up on when we're talking about it, because I'm so used to just using the shortened version of these words or names.
Yeah, absolutely. So, we hoped today with the Stocks 101 or the Shares 101 podcast, specifically focusing more on Australia. We did a bit of international stuff, but hopefully that gives a bit more of a rounded idea for people, and a bit more of an understanding and an overview at a higher level, just to sort of, feed their own brain and help them along their investment journey, or potentially just starting off on the ground floor. And that's what we heard from one of our other listeners, Andy, this week. He sort of mentioned to me that there's a few stock podcasts out there, but they go quite in depth into different stocks, and he feels like he'd love to get onto the ground floor with a podcast where they're sort of starting from a base level and working the elevator up. So that's what we're hoping to try to do, as we've spoken about previously, is to give people a broad overview, and it won't just be on stocks, it'll be all different areas of personal finance, just to try and help people from a novice to an intermediate, from the ground floor, work their way up and through life, giving them helps and avoiding tips and traps along the way.
It could be an idea that we actually allocate a small portion of capital, create an account and post it all online, just so people can see what we've done and how all these things work in practice. Because it's one thing to talk about them and listen to the podcast, but then to go back and see the resources just to see how it all works is an interesting thing itself. And you actually prompted one last thing I'd like to talk about is, if you do decide to jump in and buy some shares, one important part is record keeping. So there's a few different things out there you can use to keep the records of trades. You could, if you wanted to, just write it all down in an Excel workbook, or a Google Sheets if you knew all the information you needed. But there's a few good ones that you can use that are pretty much free in the Australian market. One is Yahoo Finance. You can write down, how many shares you bought, what price you bought it at, and how many, in what lots you bought that in. So what I mean by that is, if you have 1,000 shares in the stock, but you bought them in lots of 200, when you sell them in lots of 200, it's easy to work out all those things we were talking about before, like the cost base versus how much profit you made, and then how much tax you might have to pay on that profit or loss if you've made a loss, as a deduction. And another one that I'm familiar with is ShareSite, which you can trial for free, and they've also got a paid version. And that's the same sort of thing. You can put in how many shares you bought, what price. And I think the benefit to that one is that it tracks, if you're buying international shares, ShareSite will track the currency conversion and tell you what you've gained or lost on currency in the transaction as well.
Yeah, great tips, Arnie. And you want to make sure that you don't have the ATO coming knocking on the door, because you want to keep your head above water and keep all the record keeping nice and accurate. And it's a great example of how to do it. And I think even some of the online brokerages are now helping you keep your track of your gains and losses and transaction history. I know there's a bunch of platforms out there as an advisor that we utilise that can sort of have everything wrapped into one and helps you with the annual reports. But there's so many options out there, but I think it's more about just getting your head around it, understanding, looking at some examples, and we might look at trying to post a bit of an example of how a trade would work with a certain stock, and you would give people an idea if you from go to woe how you'd get it up, how you'd get your account opened up, how to ID yourself, how to attach an account, and then how to make a trade and show you the buys and sell orders on that trade, and then just track it over a period of time to explain it all.
Yeah, I like that. Before we wrap up, I wanted to just briefly touch on some of the news stories that we covered in the last two podcasts. There's been some major developments. Bitcoin is now up to $55,756.50 USD, which translates to $70,846 Australian. So, if you had a bought before, or if we had a bought Jolly, we would have been doing all right. It's gone up phenomenally, even in the last week. And the other big story was GME from our first podcast, GameStop, in the United States, and I think it was streamed on YouTube on CNBC's channel. You could watch the Senate hearing where they interviewed Keith Gill, also known as Deep Effing Value, for the Reddit user Deep Effing Value, and they also interviewed the CEO of Robinhood, Vlad Tenev, I think his name is, and they had the Citadel Securities guy and the Melvin Capital guy on there. So interesting to see the US senators grill those people. And if you get a chance, you should go check out Deep Effing Value's testimony, because he was very funny, stating that he is not a cat.
We'll be interested to see the outcome of that and see what comes of it. As we discussed, it was an interesting one, and we'll see out of the crazy US what eventuates with that GameStop saga. But nice to note those couple of areas. And I guess the area that we didn't pre-plan for, Arndog, was what the people came to hear was what's your choice. So when we talk about investments, you got a bunch of different investments, as we alluded to within the podcast. But when we talk about lifestyle choices, what's your choice can be many different varying things, and we have had a bit of feedback as well from that with Andy, actually, who's a friend of mine, who did say the lolly in the fridge thing was pointed at him, which I did remember was one of the sickos that does keep lollies in the fridge. So, Andy, if you're listening out there, yes, you were one of those weird people that does keep snakes and whatnot lollies in the fridge to eat. But what's your choice? So, Arnie, we didn't actually. I didn't give you the topic this week for What's Your Choice, and if anyone out there has a better name from What's Your Choice, please feel free to let us know. We're not steadfast on this one.
Well, it's changed. It was either or last week, and now you've given it What's Your Choice.
Yeah, there you go. So I've just changed it off the cuff here. So if anyone wants to change it again next week, please yell out. So either or, What's Your Choice? It could be anything, 50-50. But Arndog, did you have a topic this week, mate, or do you want me to give one off the cuff?
No, I actually have one. Have one, because I was thinking about it during the week and it prompted one. It's another food one, and it's leaning heavily on your one last week. But do you keep your tomato sauce in the fridge or in the pantry?
Okay. So It's a good one. I actually keep a small tomato sauce bottle in the fridge. And then usually if we go to Costco every now and then, I'll get a big bottle and I keep that one in the cupboard. So whether that actually makes any sense at all, I keep the small one in the fridge for short-term usage, and then the long-term one will be in there and I'll fill the small one up. So yeah, definitely in the fridge, Arn. Yourself?
Mate, this is our first agreement because I'm all about sauce in the fridge.
Okay, there you go.
I do not want it in the pantry. I grew up in a sauce in the pantry household, and I thought that was the norm. And then when I became an adult and could exercise my own free will, I was like, what am I doing?
Did Kate bring that onto you, or she grew up in the sauce in the fridge?
I wonder if it was Kate. Yeah, it might have been Kate, might have been the catalyst because... now we keep it in the fridge. And I just want to say, Andy, I'm so glad you're listening to the podcast because now you can take your lollies out of the fridge, mate.
It is funny when you become a grown up and you move out of the house, what changes and how maybe Kate's brought that fridge sauce bottle to you. But I remember the thing that I grew up with, and I've spoken with friends about this before, is I know we're doing 2 topics this week, but you're lucky you get 2 for the price of 1, is cutlery drawer arrangement. So I grew up with knives on the right, spoons in the middle, forks on the left. But ever since moving in with Ez, many, many years ago now, and purchasing our own house, she actually grew up with forks in the middle, knives on the right, spoons on the left. So we've actually stuck with that. But I do miss spoons in the middle because I grew up with spoons in the middle for 22 odd years of my life.
Oh, I bet you just sometimes second nature. You go to grab a spoon and you wind up with a fork.
Am I odd to have spoons in the middle? Did you grow up with spoons in the middle, Arn, or you spoons in the left?
We have the exact same setup as Ez, and we always have, and that's stemmed from my childhood house. I don't know what Kate's was, but currently we've got spoons on the left, forks in the middle, knives on the right, and then teaspoons down the bottom.
Yeah, I'd love to hear from anyone out there that if just to make me feel not so much of an outlier if you grew up with spoons in the middle, because I do feel like every time I've broached that subject with someone, they look at me a bit strangely. So, if anyone out there has had spoons in the middle from their childhood, feel free to let us know. It'd be great.
And if we missed anything about the shares and you want us to address it in a later podcast, please hit us up with some comments or questions on the YouTube version, and we'll do our best to address those.
Yeah, absolutely. Yell out any other topics you guys want to touch on or want us to speak about, anything related to personal finance in an easy-to-listen format, please, yell out and let us know. It's always good to hear, and it's what the people want, so we want to hear from the people and touch on subjects that are of interest to you guys.
Nice one, Jolie. All right, well, that's money in the tank for another week, mate.
All right, Dog, over and out, everyone. Thanks for listening. We'll catch you next week.
Bye, all.